I have a question. So let's kind of run through a scenario. Like we just bought a building and we actually engaged somebody to do cost seg like before we met you. It was several months ago. So hopefully it was the right decision, but we'll find out here. We bought the building for $250. It's a small industrial building. We bought it for $250. When we were sending in all the paperwork for the cost seg, they were asking, for the contract. They also asked for like the appraisal. It appraised at like, I think 350, 340, something like that. So it appraised for more than the purchase price out the gate. We also filled it with a tenant now, and it's probably worth a lot more than 350. Yeah. But question, when they do the study, is it based on the contract last purchase price, or is it based on that like market value / appraisal value?
Great question. So it is based off of your purchase price. So the IRS doesn't allow you to depreciate anything that you didn't actually pay for.
Got it.
You got a good deal on the property.
Yep.
And so that's kudos to you, but you only get to depreciate it at the 250 minus the land value. So,
yeah. So you mentioned if it was like near 250 or 200, it probably wasn't worth it. So in this scenario, I guess, do you think it would be worth it, or walk us through how that would look for us, like potential deductions and stuff?
Sure. So that's a great example. Let's walk through that. So let's say you bought it for 250. Let's say land is worth 20%. So that's 50,000. So you basically, have $200,000 worth of depreciable basis. So when we do our cost segregation study, on average, we segregate around 30%. So 30% of 200,000 would be 60,000. So we're going to go into that building and we're going to find $60,000 worth of stuff that shouldn't be depreciated over 39 years. It should be depreciated over a shorter useful life, either 5, 7, or 15. Those are kind of the buckets. So if we segregate 30% of that, there's something called bonus depreciation. So currently, when did you buy the property, in 23 or?
This was like 3-4 months ago.
Yeah. Okay, so let's call it 24. So in 2024, bonus was at
60, right?
Yep, 60%. I have to do that in my head. So bonus depreciation, let me just talk about that and then we'll go back to your example. But bonus depreciation, the government uses bonus depreciation to stimulate the economy. So when the economy is not doing well, they used to increase bonus, and that encourages people to go out and buy stuff. So if bonus was at, let's say bonus was at 50%, and I bought a $1 million bulldozer, essentially I get to depreciate 50% of that $1 million, or 500,000 in the first year. So I get a big, huge write-off in the first year. And then the rest of that, the other 50%, spreads out over the useful life of that bulldozer. So you can see how that incentivizes people to go out and buy stuff when they increase bonus. So with the Tax Cuts and Jobs Act of 2017, Donald Trump was the president. Donald Trump owns real estate. And Donald Trump, when he revised the tax code, he made it very favorable to real estate investors. Two things changed. One is, at the time, it was 50% bonus. They changed that to 100% bonus. So any assets bought between September 27th of 17 and 12/31 of 2022 were eligible for 100%. Then it slowly phases out. Anything bought in 2023 was 80%. Anything in 2024 was 60%. That's the first thing. The second thing is the old rules of bonus only applied to brand new assets. So you couldn't buy a used industrial building. You would have had to build a brand new industrial building for it to be eligible for bonus. But in the tax code, they were really slick how they did it. They added 5 words to the tax code that made that change dramatically for investors. So they added new to you, the taxpayer. So now I don't have to go buy a brand new bulldozer. I can go buy a used bulldozer. It's new to me, the taxpayer, and all of a sudden I'm eligible for bonus. So in your guys' example, you just bought an industrial building. It might have been built in 1980. It doesn't matter. It's now new to you guys, the taxpayers, so you're eligible for bonus. So in your case, you bought it in 2024. You're eligible for bonus at 60%. So if we segregate, what did we determine? We segregated
30%, you said?
30% of 200,000, so that's 60,000. Now, of that 60,000, you're going to get 30% of that all in the first year.
Because that's a 50% bonus.
60%.
Okay, so like maybe a little more than 30,000.
No. So you've got a $60,000 deduction.
Okay.
You got 60% bonus. So if you take 60% of 60,000, yes, my math. That is, what is that? 60% of 60,000.
36,000.
36,000. So you're going to get a $36,000 write-off in the first year. The rest of the stuff is going to spread out over each of the individual class lives. So all your 5-year stuff, you're going to spread the rest of it out over the next 4 years. All your 7-year stuff, you're going to spread the rest of it out over the next 6 years. So you're going to get a $36,000 deduction. So if you are in a 30% tax bracket, Take 36,000 times 30%. That saves you about $11,000 in taxes.
Mm-hmm.
So I don't know what you paid for the study, but as long as you paid less than $11,000 and you're not going to sell the building in the next couple of years, you're going to come out ahead.